If you ask an AI for the optimal pricing strategy, it will give you the statistically perfect answer. But what happens when your three biggest competitors ask the exact same question? In 1998, a room full of Nobel laureates almost destroyed the global economy because their math was too identical. Today, enterprise AI is setting us up for the exact same systemic failure on a scale we've never seen. Right now, the world's biggest corporations are rushing to hand the keys to their pricing, supply chains, and marketing strategies over to a handful of massive centralized large language models. They think they are optimizing, they think are gaining a competitive advantage, but what they're actually building is a financial time bomb. Today, we're going to look at the terrifying economic concept called algorithmic isomorphism. We're going to explore why identical intelligence leads to identical blind spots, and why the next global market crash won't be caused by human greed, but by the fact that every AI on Earth is about to make the exact same mistake, at the exact same millisecond. In 1998, long-term capital management was the smartest hedge fund in the room. They had two Nobel Prize winning economists, Robert Merton and Myron Scholes, sitting on their board. They possessed the ultimate mathematical models for predicting bond prices. And for a while, it worked perfectly. They were printing billions, but then an anomaly hit. The Russian government defaulted on its debt. LTCM's models hadn't properly accounted for the extreme outlier. But one bad model doesn't destroy the global economy. What almost triggered a worldwide meltdown was that every other major bank on Wall Street was using the exact same type of math. When the anomaly hit, the math told everyone to sell the exact same assets at the exact same time to cover their losses. Imagine a theater that caught fire, and every single person mathematically calculates that the front left exit is the most efficient way out. You don't get an orderly evacuation, you get a fatal stampede. When everyone is on the same side of the trade, liquidity vanishes. The Federal Reserve had to orchestrate a $3.6 billion bailout just to stop the contagion. Fast forward to August 2007, an event known in financial circles as the Quant Quake. Quantitative hedge funds operating highly secretive algorithmic trading strategies suddenly began suffering massive, inexplicable losses. Why? Because it turned out their highly secretive algorithms weren't actually secretive at all. They had all converged on the exact same statistical arbitrage strategies. When one fund was forced to liquidate, it triggered a massive automated fire sale across the entire sector. The algorithms saw pricing dropping, so they sold, which dropped prices further, which made the algorithms sell. It was a machine speed death spiral. These events taught us a critical, terrifying lesson. Financial fragility doesn't come from bad math. It comes from identical math. And that brings us to the modern AI arms race. In 1983, two sociologists, Paul DiMaggio and Walter Powell, published a seminal paper that explained a strange phenomenon in business. They asked a simple question. Why do all large organizations eventually start to look and act the exact same? They called the answer Mimetic Isomorphism. The theory states that when organizations face extreme uncertainty, like a massive, unproven technological disruption, they panic. Instead of innovating, they blindly mimic the actions of whoever looks the most successful at the time. They adopt the same corporate structures, the same strategies, and the same technologies purely as a defense mechanism. It's a corporate herd immunity. Now, look at the global landscape today. Every Fortune 500 CEO is terrified of being left behind by artificial intelligence. So, what are they doing? Well, they're practicing perfect mimetic isomorphism. They're all plugging into the exact same foundational large language models, whether it's OpenAI's GPT-4, Anthropic's Claude, or Google's Gemini. The underlying architecture is practically identical. More importantly, these models are trained on similar data coming from the internet. They're sharing similar base weights, same reinforcement learning protocols, and similar fundamental biases. When a global logistics giant uses AI to optimize its shipping routes, and its two biggest competitors use the same AI API to optimize their routes, the market doesn't actually become more efficient. It becomes a monoculture. In biology, a monoculture is incredibly dangerous. Think of the Gros Michel banana, the species that dominated the global market until the 1950s. Because every banana plant was a genetic clone, they share the exact same vulnerability. When the Panama disease hit, it wiped out the entire global supply almost overnight. Right now, we are creating a cognitive monoculture in the global economy. If a foundational LLM has a hallucination, a data void, or a blind spot regarding a specific geopolitical event or market indicator, it's not just one company's blind spot. It's a shared, systemic vulnerability across entire industries. We are replacing a diverse ecosystem of human decision-making, which is messy but historically resilient, with a perfectly streamlined, highly brittle, identical synthetic brain. So what does the next crash actually look like? It's not going to be contained by high-frequency trading desks in lower Manhattan. We're looking at what could be called the flash crash of everything. Let's move away from the stock market and look at the real economy. Dynamic pricing algorithms are already ubiquitous. Airlines, hotels, and massive e-commerce retailers use algorithms to adjust prices thousands of times a day based on competitor data and consumer demand. Now imagine upgrading these localized algorithms to interconnected, enterprise-level AI agents. You have a scenario where AI pricing systems are negotiating with other AI purchasing systems. AI supply chain managers are ordering from AI logistics providers. Everything is operating at machine speed, completely detached from human oversight, because humans simply cannot process data fast enough to intervene. Let's say a minor, highly localized anomaly occurs. A brief spike in the price of a critical raw material or a piece of AI-generated fake news that temporarily alters global consumer sentiment data. The first AI detects the anomaly and instantly slashes its inventory. The second AI detects the first AI's massive sell-off, assumes there's hidden risk, and responds by slashing its own inventory. The third AI reacts to the second. Because they're all built on the same underlying logic, they validate each other's panic. They form an instantaneous closed-loop feedback mechanism. In the 2010 flash crash, the US stock market lost nearly $1 trillion in 36 minutes because automated trading algorithms entered a feedback loop of aggressive automated selling. Now, apply that 36-minute death spiral to global supply chains. Apply it to airline pricing. Apply it to commercial real estate valuations. When every corporate AI realizes it needs to exit a market or dump inventory at the exact same millisecond, there will be no buyers on the other side. There will be no diverse opinions holding a line. There will only be the mathematically perfect, collectively engineered stampede toward the cliff. The market will seize up entirely, not because the AI is stupid, but because the AI is exactly the same kind of smart everywhere, all at once. The great promise of artificial intelligence is that it will unlock unprecedented levels of market efficiency. And it will. But in systems theory, maximum efficiency is often indistinguishable from maximum fragility. A system with zero slack, zero diversity of thought, and zero friction is a system that shatters the moment it encounters the unexpected. The 1998 collapse of long-term capital management and the 2007 Quant Quake were the warning tremors. They showed us what happens when brilliant humans rely on the exact same models. The coming crisis will show us what happens when we remove the humans entirely and let identical models run the world. We are rapidly approaching the terminal point of algorithmic isomorphism. The question isn't whether an anomaly will trigger a catastrophic feedback loop. The question is simply what that anomaly will be. Let me know what you think in the comments below. Do you think government regulators need to step in and force corporations to use distinct, independent AI models to prevent a monoculture, or is this technological convergence totally inevitable? If you found this breakdown valuable, please hit the like button and make sure to subscribe to the channel. We'll see you on the next one.